This video presents a unique triad investment strategy that combines an unusual market timer with a select group of market indices and sound money management. The presentation will show that this strategy can generate robust returns with low drawdown and small market exposure. It does not take a sophisticated trader to implement the strategy. All of its components are permitted in IRAs. I call this strategy Portfolio Builder. Its market timer integrates long and short-term technical data with market sentiment. It marries the timer with a strategy that trades ETFs of selected major indices. I use leverage to generate exceptional returns. The money management, timer, and ETF strategy collectively minimize the drawdowns. Previously, as an analyst, I had developed market timers and trading systems. Portfolio Builder is an advancement over those earlier systems. This timer reports one of three market states: bull, bear, or neutral. The core of this system's money management is a grab the cash and dash philosophy. Portfolio Builder normally trades with the market direction. Under the right conditions, Portfolio Builder will also trade in neutral markets. It takes both market timing and ETF strategies to produce this powerful Portfolio Builder trading system. Neither alone is sufficient. Both together provide the needed balance. It's a yin and yang partnership. There are three inputs to the timer: daily and weekly S&P 500 data, plus a measure of market sentiment. Volatility serves as an indicator of sentiment. The timer has three output states: bull, bear, and also a neutral state when the direction is flat or uncertain. The incorporation of weekly market data leads to conservative entries. The other parts of the system lead to quick exits. Our grab the cash and dash money management strategy adheres to a wise investment homily: enter slow and exit fast. The ETF strategy is like a machine that digests its three inputs and generates three types of output. Its criteria for opening a position is different for directional and neutral timer states. This machine directs skimming of profits and equity at risk as the position value grows. I will demonstrate on later slides that you are safely in cash most of the time. Each of the ETF pairs I trade is comprised of a leveraged ETF and its inverse. One moves in the same direction of its index, and the other moves in the opposite. The bullish ETF goes up in value as the index increases. The inverse ETF goes up in value as the index moves down. For example, TNA and TZA form the 3 times leveraged ETF pair for the Russell 2000 Small Cap Index. Each 1% change in the Russell corresponds to a 3% change in TNA and a minus 3% change in TZA. Inverse ETFs were introduced a few years ago to get around the IRS's prohibition against shorting in IRAs. Portfolio Builder uses inverse ETFs to trade in bear markets. A common strategy was developed for these 10 ETFs. At any time, either the bull or bear ETF is not traded. The machine determines which one of the pair. It also indicates whether a trade can be entered in a neutral market. A portion of profits is skimmed as equity grows. Full exits are executed with a timer change or a pullback in equity. Experience reveals a repeating pattern. After each big run-up in profit, it seems there is a comparably big pullback. Many investment managers recommend adding to a position as it's rising in value. In contrast, the portfolio builder strategy subtracts from the position size as profit increases. If timed properly, this reduces the amount of profit given back. Plus, it minimizes risk by adding profit and returning invested equity to cash. However, we do not want to have closed our position while the market is still rising. At the same time, we need to recognize the possibility of a dramatic pullback after a bubble. Here's a summary of my grab the cash and dash money management philosophy. I never add to a position as profit grows. Not only are profits skimmed, but the equity at risk is also reduced. Equity is simultaneously taken off the table as the profit grows. I don't think twice about an exit. Given a signal, I exit. I don't hesitate, hoping for a reversal. The next few slides will exhibit the backtesting results. The bull trades are at the top of this table. The bears are on the bottom. These are called inverse ETFs. Column 4 shows that the percent of winning trades is consistently high. From a trader's point of view, the next column, profit factor, is the most important. It is the ratio of profits to losses. The bigger, the better. The last column shows the annual rate of return. These returns are excellent by themselves, but you will see these numbers become much more significant when the bear trades are combined with the bull. Don't be surprised that the ETFs with the largest losing trade are also the ETFs with the best annual rates of return, EDC and ERY. The next series of slides will show the power of trading in both bull and bear markets. You will see that profits grow exponentially. This table shows Portfolio Builder keeps you safely in cash over 75% of the time. High probability entries are generated only when conditions are ideal. Profits are captured over very short periods of time. On average, your equity is at risk less than 7 days. It is easy to see in these charts how trading in both bull and bear markets amplifies returns. What appeared to be as a modest annual rate of return for BGU turns out to be an impressive results for the big caps when including BGZ. These annual rates of return are unmatched by any other ETF trading system. You can see from these graphs that the losing trades are sparse, small, and rarely consecutive. The winners substantially outnumber the losers and are much bigger in magnitude. These equity graphs demonstrate that drawdown is minimal. Clearly, there is an ideal marriage of the timer with the strategy for these ETFs. Putting it all together, when we diversify by investing in each of these families, we find the investment strategy we are looking for. Each time one of these 5 ETF strategies generates a signal, only 20% of the available equity is used. The resulting rise is fairly smooth and persistent. Losses have been diminished by a factor of 5. Drawdown is comfortably below 10%, and the annual rate of return is hot. You still need answers to some critical questions. It's unrealistic to expect these types of returns. Commissions and slippage always affect the results. Our timing may not be the same. And don't forget how our emotions often interfere with our trading. Plus, the market is always changing. Collectively, you have seen impressive returns for 10 ETFs using a common timer and investment strategy. These are not anecdotal results. Money management plays a key role in this system. Portfolio Builder provides diversification across 5 sectors with ETFs of indices representing thousands of stocks. This is a system you should consider to help build your wealth. Through my newsletter, you will be trading when I do, not after. You will have plenty of time to plan your trades. Contact me if you have any questions. No question is ever trivial, and I am here to help. Subscribe to my electronic newsletter and profit from my trades. As a bonus, I am offering you an opportunity to evaluate my newsletter of a similar system for trading gold and silver ETFs. Thank you for watching this presentation. I'm in the process of building my new website, Grab the Cash and Dash. You can visit it, but it's still under construction.